Good morning. I'd like to welcome everybody to the Audit and Finance Committee meeting of CCIDA, CREDC, and CRC towards BWB Building, 201 West Third Street, Jamestown, New York. We're also streaming live via YouTube and Zoom. It's March the 17th at 9 o'clock. We'll start with roll call. Gary Henry's here. Sagan Sheffield Smith.
Here.
Do we have an approval for the February 10th, 2025 minutes?
So moved.
I'll second that. All in favor, say aye. Aye. The minutes have been approved. We'll move right into new business, the discussion of the audit of the 2024 financials.
Okay, so we got three documents for you in front of you. I'll start with the financials, the largest one. If you want to turn to page 1 to start, we'll talk about audit opinion letter. So this is a clean, unmodified audit opinion, no modified wording of any kind. So this is kind of what you're shooting for, is to get a clean audit opinion. So you did receive that, so good job, Kayla and the team. You know, you'll notice if you went back a couple years, the form of the letters changed, but it's just where the paragraphs are over the last couple of years. They move things around every once in a while, but this one matches last year. So that is like change from a couple of years ago. Pages 3 through 8, I think. 7. This is what's called the management discussion and analysis. It's kind of a narrative format. So if any board members wanted to read through, this is probably where I'd send them. It's the easiest, most digestible way to get the information. But it's, you know, I'm an accountant, so we're gonna go over some numbers. But, you know, if somebody on the board said, hey, where should I spend the time? That's maybe where I'd send them, especially if they're not as financially.
We should probably take my name off of page 7.
Okay, yeah.
And let's go.
Yep. And then maybe Mark and Shelby on page 7. There's a yellow highlight. It's like trying to give the reader anything of significance that might be in the works for this coming year. That's kind of what we had last year. And so maybe that still applies a little bit, but if there's anything you'd like to change as far as the wording or add to the wording, let us know and we can modify that section.
There's a typo there, but.
Okay.
And existing industrial park to expand and. Right?
Yep.
I'll look at that. No,
Yeah.
Yeah, I didn't know. You can't have mine.
Okay.
Not allowed to have a red pen.
All right, so then we'll go to page 8 and start talking about, so this is the consolidated balance sheet. So you'll see the CCIDA, the 5 funds that kind of make that up. I did add the EPA Brownfield Revolving Trust as a fund of the CCIDA. Not much activity. I probably could have kept it in the IDA for another year, but you know, as things start to happen there, it might make sense to have that broken out, especially with the loans. And then the far right column is CREDC, and there's some consolidating schedules in the back of how CREDC and PEG kind of flow together. As far as, you know, the numbers on here, you've still got pretty healthy cash balance, down a little bit from last year, but that's really because you're spending down on the grants. A lot of unearned revenue last year that's, you know, came back off the balance sheet here. The middle of the page, the other assets, your notes receivable and the allowance. So we went with 20% like we have the last few years of reserved against that. You know, I did fill out all that CECL stuff again this year, and I went through the history of the last decade of, you know, your losses and write-offs. And it came out with about 17% on, I believe it was the LTEC. And then I think the EP or the EDA, I think was about 15. So that's what they thought the loss history would be over the time. You know, so you guys are conservative in your 20%. And, you know, it does, you'll see it on the next page. It hits your bottom line a little bit in those 2 funds because you loaned a lot this year. So, you know, reserving against those new loans, we're adding expenditures to the income statement. But, you know, if you were to factor that out, that, you know, you had pretty successful years over there. But those balances are up because you're pretty much fully extended on those loans as of December. There isn't much else to give out.
You have to make that call, Rich.
Yeah, we do. We're gonna reach out to EDA To let them know where we're at. I mean, I think the fact we did it before helped us because then we didn't know COVID was gonna hit, but 6 months later, COVID hit and they called us.
Gave it.
"You spend that money you said you could. We said, yeah.
Yeah,
Yeah,
they could have money sort of kicking around that
Yeah.
they had sort of allocated to other
Yeah.
folks like us
Yeah.
that weren't able to get it out there. And
Right.
now we've got a backlog of people waiting to say, look,
Yeah.
we could, if we had, make up a number,
right.
we could get that out working on the streets right now.
Yeah.
Well, during COVID, or once we got the 10.5 million, our contact at EDA had said that he was impressed with how smoothly we got all that money out the door because there were a lot of IDAs that had a lot less and couldn't manage to get that out. So,
Right.
Yeah, so we're gonna make that.
I think that, and then your experience has been like really good.
Yeah,
right.
You know,
our track record.
your track record as far as like your write-offs. I mean, you have a couple here or there, but this past year, the experience was really good. I mean,
Yeah.
really good experience.
Really.
So that kind of,
Yeah,
that's the story as well.
yeah, and the fact that we've been doing this for decades.
Exactly. Yeah.
So then half of the page, there's your current liabilities. The big number there to talk about is the unearned revenue. You're at $5 million this year, sitting unearned. We're still on page 8.
Oh,
$5 million unearned. That's money that you've been given to spend on projects. That's down 2.6 from last year. So a big part of that is the $1.5 million that went back to the county from the broadband.
Yep.
So that's a big part of it. So, but
mhm.
otherwise that means you spent about $1.1 million of that money this year.
Yep.
So, and you did get some more grants this year. So you probably actually spent more than that. It's probably more like $1.5 million, and you received some on like Ralph Wilson, things like that.
Mhm. Yep.
And then, yeah, we can go to page 9 now, income statement. So, the top line there, application administration fees, that's up. Really the Wells project's the main contributor there, some good fees from Wells Enterprises coming in. This year, that was all recorded and it's on your balance sheet and will be, realized over the next couple of years, but the revenue all hit this year. Grant income, a lot of pay grants, and really what that is it's spending funds. So most of it was stuff that had been received cash in prior years. Now you're spending it, it's, being moved out of deferred revenue, unearned revenue into revenue that's hitting your bottom line.
Mhm.
And you can see that in your expenditures. Your expenditures are up quite a bit. Grant funds is really what that is on line 3, general administrative, a lot of grant funds in there. And then number 4 that I was going to talk about, 505, the bad debt expense. So that's what the adjustment was for the bad debt this year. As I said, most of that is due to the fact that you loaned out quite a bit this year. Both funds, LTEC and EDA, had quite a few new loans. So as those new loans come on the book, we're going to have to, recognize the 20% on those. So that's what drives that. Now that you're kind of fully loaned right now, the anticipation would be as people pay that balance is going to be a gain next year, probably as we have to lower those funds for the amounts being paid. And then you can see bottom line, the excess deficiency revenue in IDA made 400,000, really the Wells drove that. The revolving loan fund pretty much broke even, 87. See the LTEC and EDA carriers both lost money, but as I said, we had to add quite a bit, 281 for LTEC of bad debt expense. You factor that kind of paper transaction out, you made $240,000 there. And same with the EDA cares fund, net loss of 93, but we wrote off 215 as a bad debt reserve. Factor that out again, you made, 120.
Mhm. Mhm.
And then CREDC just had a decent year, the 93,000 there as well. That was in the main CREDC fund, really, because the PEG is mostly in and out, deferred revenue, yet revenues match expenditures. So that was in CREDC itself.
I was just gonna mention, so in the fees, as Justin mentioned, the Wells administrative fees included in that. Only a small portion of your Connect Gen is in there, even though that's a larger amount, but your policy is to recognize that as revenue when the project's under construction. And that really hadn't started as of December of 24. So once that kind of hits the ground running, you know, that'll be recognized, even though the payments will come in over time as well.
Mhm, mhm.
So,
Hopefully this
Do
year.
we know do we know how they're doing?
Yeah, they're doing well. They're planning, getting ready. They might have done a few little things last year, but
Yeah.
spring is when they're gonna start.
Yep.
Yeah, so I think that's $1 million over the 7 year. About 100,000 a year.
Revenue, yeah.
So I think for 25, I think we put them
you've
in,
already put it in, okay.
I put in all the aged receivables.
Anticipating they're gonna break ground in the spring.
Yeah, they're definitely gonna roll.
Yeah,
They've got a lot of money invested in that. I don't know how they cannot start.
Yeah.
Yeah.
All right, page 10, we won't spend a lot of time on this, but I just think what's nice for your entity and like the whole purpose is infuse funds into your community. I think you see that net change in cash line. If you go over to the far right column, the total, you really put $4 million back in the community. $1.5 million of it went to the county, so that's a big portion of it. So really, but $2.5 million back, whether it was loans or other ways you're spending cash on those grants. So I think that's for your entity. I think that's kind of a nice thing to look at, like to
Yeah, I
see.
never thought of that, Justin.
I know, me neither.
That is interesting.
Yep.
That could be the CPEG's grants to.
Yeah, CPEG's
communities.
grants, a lot of that.
That's like 250 or something like
Yeah.
that, I think last year.
Yep.
Yep.
Yeah, and the loans that go out, that's also
Yeah.
Yeah,
factored in
Big
there.
part of it,
Yep.
for sure.
Loans and grants. Mhm.
Pages 11 and 12, we won't spend too much time on it, but because of your retirement plans, your fiduciary, and we report the balances of those. So that's your deferred comp and your 401k or 401, whatever letter you are, is it A?
Yeah,
So, yeah. All right, so page 13 starts the notes. I would, on the bottom right-hand corner, we hadn't broke it out as a separate fund. So I did add a little blurb on the EPA brownfield. If you wanted to read that to make sure you agree with the writing, but I put together a blurb kind of similar to the other loan funds. But that is new and broken out of the fund there.
That looks good. Short and to the point. Yeah.
Page 15, we'll jump to, so not a whole lot of big changes in the notes. Obviously you've got your tax lease note that starts on 14, goes into 15, talks about the $2.8 million you pass through. I think that's kind of an important aspect of your entity is that role you play in your community. And then also on the right-hand side, there's letter O, the new accounting pronouncement. So there is GASB 101, which is compensated absences. So we did have to evaluate that and spend some time on that to make sure we felt comfortable with the way you're reporting your compensated absences. And I got the employee handbook and reread it and made sure, are we handling it right? So we did spend some time on that just to make sure we're doing the right thing there. Now, the way you guys you've always recorded your entire vacation accrual as a liability. Sick, you don't get paid out, so that hasn't been there. Personal, people usually use it, rolls into sick.
No,
Or-
lose it.
Lose it,
Yeah, you don't use it, you lose it.
you use it, lose it. So
Every year.
every year.
Yeah.
So the only part of it that, is accrued for is vacation. So, because of that, the way a lot of entities kind of do that, they don't record that all as a liability right away, only as people are getting closer to retirement. So GASB 101 is kind of changing that and saying, no, even the youngest person, there should be a liability there because it is a perceived liability in the future. So it didn't have a huge impact on you because you record 100% of everybody's payments. Now, could there be some impact if you really wanted to get into the weeds of like discounting it for the future and things like that? There could be. We chose not to do that. We kind of view it as people use it. Generally the balance has been about the same the last few years. It's not really growing significantly. usually people closer to retirement seem to bump up their balances a little more, knowing they're gonna get paid at the end of the year, or at their retirement date, but not a huge impact, but we did evaluate it.
I don't ask Jeanette about vacation.
Hey, Justin, on H, at the bottom of H, tax lease program.
Mhm.
It says the agency's pilot program generated $2.8 million in 2024 for local municipalities. Is that local taxing jurisdictions? Is that the county, the munis and the schools?
Yep, all three.
Okay, so you use municipalities?
Yeah, maybe we could possibly.
Yes.
Shouldn't you say taxing jurisdictions, including, municipalities, the county, and the school districts or the school?
Towns.
Village, town, well, that's why I say municipality sort of covers,
All those.
Yeah, just municipal.
yeah.
And last year that was 2.5, so that's up a little bit.
Yeah.
Up about 300,000,
Yeah.
5% roughly.
Yeah, that's a good number.
Solar pilots are starting to
Yeah, exactly.
Yeah, right.
come to fruition.
So if you want to go to page 16, we have a pretty good note on your other receivables there. So that's where most of these administrative fees broken out of what's left to be paid on many of those. And we have a schedule later on where that shows each one what's due like each year. So those are good notes to look at. Not a whole lot going on property, plant and equipment this year, so not a whole lot to talk about there. Page 17, unearned revenue. So this is your deferred revenue, unearned revenue. That's about a page and a half there. So it is, we try to hit every bucket of unearned revenue, unless it's just real minor. So every piece that's sitting in unearned revenue is described here. And even I think the minor ones, I think we have a kind of a generic one to say that this is there. So if you wanted to go back and add them up and take them back to the face of the financials, it works. But every kind of bucket you have and what's left to be spent is kind of described there. And I think that's a good note. I mean, just talking about all your PEG funds really, that starts about halfway down the other page. That's credit works. But yeah, we went, it's a lot of tracking for Kayla and a lot of tracking on ours to make sure, okay, does it work? Does it make sense? Trick going back to the original infusion of cash and what's been spent and things like that. But
Well, Justin, every year I start the year off thinking, I'm gonna keep this as clean and pristine for the auditors as I can. And then somewhere in the middle of the year, I'm like,
Can't keep it all straight.
yeah, and I think it's actually our big struggle is we merge a lot of your funds together. So that makes it hard where you have them all each separately broken out.
Yeah.
So there's a lot of going through the GL detail to try to figure out, okay, what bucket did this come from? Where were these funds spent? And I think you can see in the general ledger, there's a lot of, Nate wants to move this money over here. There's a lot of Nate names and descriptions in there. So yeah, there's a lot of movement there. So, it's a lot to track, I'm sure. Page 19 starts your notes receivable. It's about 4 pages. It goes to page 22, so 3 pages. So every single note is described in here, what the monthly payment is, what the current interest rate is, what the balance is.
Can we, real quick before you do that, can we, so for the Luscombe,
Yes,
is that in here? That
Yes,
whole
it
thing
is.
about the,
let's go.
sale of the equipment and I'm just,
It's on the bottom of page 21. And it's just,
Oh, okay.
we left it as simple as the loan is currently in.
oh, okay.
Would you like more?
No, that's good. Okay. I was just curious if that was.
Yeah.
Okay,
And that's
Go ahead.
really the only one you have an issue with.
And
Right.
There's a smaller one, I think.
we had the auction, we got the proceeds. Yeah, attorneys are preparing letters to go after the 2 principals and their personal guarantees are both in California, so hopefully we can play, let's make a deal with them and get that taken care of. We're doing the work for Stito as well,
Okay,
so.
Yeah.
I think had to sign some letter from the attorneys, I think he signed it, so.
gotcha.
But we're handling all that for them too.
Okay.
But yeah, every loan, all the new loans are noted as being new. So most of them, you'll notice loan awarded during 2024 if it's a new loan, but every loan is in there and except for I think emergency working capital loans you guys got a couple years ago, those are gonna go kind of a black.
Yeah.
By themselves, but. But a lot of good information, see all the entities you're assisting.
We're not paying you guys enough.
Fred Larson should come. Look through here, you know.
Kidding.
Note 10, long-term debt, not a whole lot going on there. You're making your regular payments with the exception of that, the middle one there, the 81,000 for the storage hangar. That one's kind of interest only and you know, you're kind of dealing with that.
Airport hangar, Mark,
Yeah.
we talked to Kitty about.
Yeah,
Uh,
yeah, we're trying to get that out.
Since Steve Abdell has retired from the county, that's kind of fallen into the cracks and
Okay,
nobody's sure what's going on, but Steve is, help us take care of that with them. I wanted to, we've already
Nice.
appreciated it,
yeah,
but I want to get that off. They should write theirs off. We should write ours off.
Yeah.
Yeah.
It's
it'd be nice to get rid of it.
Yeah,
my mission before I leave.
Right of use asset, operating lease. I think that's kind of interesting, just to remind you that that's really about your rent for the,
what page are you on?
that's 23 to 24. So
Okay.
it goes over.
Oh, yeah, I see it. Yep, no,
That is, you know, really your rent for property. You know, you don't have equipment leases. Most people see a lease liability. They're thinking a long-term capital lease for equipment or something like that. But the way they changed that, you know, a lot of rental agreements a couple years ago, if you remember, moved on to the balance sheet.
Yeah.
As they're no longer operating in month-to-month payments, they're, you know, an asset and liability. So just like to point that out, just so somebody who's reading it might wonder, what kind of lease do you have? Well, it's really your locations.
And the lease that you have for this space is actually gonna be done next year. But then you have a 5-year option, and I think when the lease standard was put in place, we had a discussion about, you know, should we include the 5-year option? That, and it was determined it's more probable that we would stay here, and so that's included in the calculation. So you can see on page 24 at the top, you know, that basically goes to year 2031, which is the original plus 5.
Yeah.
And once you make that determination, it kind of stays, you know, if you were to say like now, geez, we're not sure, but it's a little more iffy, you would still keep that in here unless something specifically changed. If you decided you were moving, then we would make the adjustment. But until that point, you kind of keep it in the calculation because that was the first decision that you kind of made.
Yeah, and it's really mostly balance sheet. I mean, there's a little impact to your bottom line, but it's a liability and an asset that are generally pretty close.
Pretty close to one another.
Yeah, they almost wash.
Hey, note 12, we kind of talked about your past few transactions, but we did add a sentence there. You won't notice other years talking about I think it was the Wells pilot. They paid in December for January 2025. You quite often have that happen. It's just usually smaller amounts, so it's usually kind of gotten buried in accounts payable. But we pulled it out and put it in due to other governments and disclosed it here since it was, you know, a material amount, 115,000.
Yeah,
So just a prepayment almost. But yeah,
it's a check. I'll just wait until January to deposit it. But they wired it to us, so I was like, oh, well, it's there.
Yeah, I feel like it happens almost every year, somebody, but usually it's $5,000, $8,000. It's not 150.
Yeah.
So, you know, we pulled it out this year. And then note 17 there on the bottom right of the page starts the projects, you know, the Immunity Bio, Electrovia, and Wells. And, you know, next year, hopefully ConnectGen is gonna be on there as well. So, and it has the schedule of the payments in the future and, you know, what makes up their receivable at this point. And then we have, you know, to kind of wrap it up, there's those two notes, note 20 and 21. The partnership for economic growth, if there's any update to that you want to make. But we just describe how much money is you know, deferred to be spent on those. And then, you know, the note 21, I think LTEC pretty much for as long as they were loaning, we had a note on that. Now that they're kind of non-federalized, we took that note away and we have the CDA CARES loan note. We'll probably have something similar going forward there, just describing what's loaned out there. And then maybe as the EPA brownfield starts to ramp up, we'll add a note for that one as well, but nothing there yet. Questions? All right, so then the supplementary schedule starts, a lot of it is kind of consolidating for critic, and so how do you get from the operating critic fund and the PAG? There's also the general administrative schedule there. Page 27 is the tax exempt bonds. Nothing back yet, right, from those, so we do need those.
Yeah, he's on my list.
Yeah, so we
Hey,
gotta,
Dave,
Chris Canada.
Chris Canada.
yeah, so we gotta get on their case to get those kind of off our list. So we
4 emails back and forth.
And you just have to disclose that as supplementary, like that means nothing to your numbers, it's not in your balance sheet at all, it's just a disclosure thing you guys have to do.
We have to report it on the parent.
Yeah.
We need it by the end of the month.
Yeah,
Mhm.
so, yeah, so once you get that squared away, we can, get those new numbers in there and unhighlight it.
Worst comes to worst, we call the company like Lutheran or whoever and say, hey. send
Well,
me
I've
an email
actually,
with what the balance is.
JCC and I think it was Lutheran, the housing, both said they paid theirs off in 2024, so.
Oh, really?
I have to have an email.
Yeah.
Mhm.
Okay. So then included at the back of the full financials are two more letters. The first one on page 32 and 33 is the government auditing standards, since you're kind of considered a government auditing entity. But this is called the Yellow Book letter. Nothing really to report here. It's a clean letter. But we are required to report on it. It's more focused on internal controls and things like that, and compliance. And then page 34, similarly, but this is on the federal monies you get, because the EDA fund is federally funded. You guys are always gonna have a single audit really, until that's defederalized as well. But we have to test that program really because of its size to be able to get coverage. And, there's no finding this year. Now, if you remember last year, you actually did have a finding, so we'll go to page 38 to talk about it. So last year you had the finding related to loaning stock repurchase or capital.
Oh, yeah.
Yeah.
And, generally the EDA funds and the federal loan funds are not to be used for that, but you can, if you think there's imminent that it's gonna be closed or relocated, you are allowed to make that. So you guys add to your or your board resolution for that fund or loan last year. At the meeting we were at to, get that wording in there, make it clear that you were going to, use the exception to that rule. Well, then we added to current status. You actually did that again this year, but you did it right. So we made sure we put that in the current status that, you did a similar loan function this year. I think it was in March or May, so a couple months after we spoke to you. And, you went through the process and it is very clearly stated in the board resolution that, that loan was for stock repurchases, but, due to imminent relocation or closure. So.
It'll be the same with roll form.
Yep.
So that was good.
Yeah, it was good to see the correction made on something other than the one we found it on. And, just to think about that. The loan committee, it was discussed a lot in there. So I was hoping when I went to the board minutes, it'd be very spelled out in that resolution. It was.
See, we are teachable.
Yeah.
Justin,
Dogs have-
so we get two sides, the final report.
Yeah, like kind of like the one I have. I printed for myself. Okay.
That'd be great.
Yeah.
I will get comments on that.
The only problem is it's hard to.
Yeah, there's some of them.
The margin
Yeah, some of the margins are.
might be difficult. We'll see if we can, Rich.
Okay.
Might be tough.
So then there are two other letters we give you. The first one, the one that starts with, we have audited the financial statements. This is called the governance letter. It's a clean letter. There is some wording related to GASB 101 and the implementation of that. And then at the back of it, there's actually an audit difference. You've got this audit difference every year. It's related to your accrued payroll. So you don't record accrued payroll. You just historically never have. So it is a $22,000 balance this year. But when you factor in what last year's would have been, the net change or impact to your financials is only $5,000.
Mhm.
So we just post it to the audit difference every year rather than have you go through and post that accrual and reverse it and things like that. So just the same audit difference we've had for a number of years. And then the final letter we have for you is the management letter. And we left the service contracts on there. I don't know if you remember us discussing this last year, but this was where the county kind of came back and said, no, you guys aren't sub-recipients, you're a contractor. So, you know, those, like, especially the PEG funds is what it really impacted.
Yeah.
They're not flow-through funds that you need to follow single audit rules for. They're more of we see you as a contractor. And we just thought prudent to leave it in there because there is some risk there. What if the government came back and decided we don't agree with that stance? You seem more like a flow through entity. There's some risk to you that, you know, you should have been following single audit guidelines. Are you following single audit guidelines from what we saw in years past when we did audit those programs? It seemed like you were, but there are some extra hoops in terms of reporting and things like that
Right,
you should do for to the county as a sub-recipient that, you know, you probably aren't doing right now, since they're considered more of a contract. So there is some risk there. If somebody ever came back and told the county, no, those aren't contracts, you might suddenly be asked to, you know, go back to reporting it more like a flow through amount of money.
Yeah.
And then the second comment, cash balances. So we noticed your money market wasn't earning very good interest. And currently in the, you know, you can get close to 4% from banks on cash. You're really probably learning less than what was pre. So it may be whether it's reaching out and saying, well, hey, they're not going to give you the extra interest rate unless you ask for it. So it may just be a matter of reaching out to them and saying, hey, you know, we know you can get 3.5% to 4% on a savings account right now. Why are we still at 1%?
Mhm.
Or possibly even moving funds to a different type of account to be able to realize that. But with the cash balances you hold, you know, that could be a significant amount of money.
Right.
So.
The only other item we didn't put in here, but I think Justin talked about throughout the presentation is like that unearned revenue. That's a big number. There's a lot of work involved. And just wondered, and maybe you're doing this, so that's why we didn't put anything in writing. We just thought we could talk about it, but you know, would it be worth if you're not doing something already, like once a quarter or once a month, provide to the board to say, okay, here's our unearned revenue at the beginning. Here's like the things that we've done. And so here's the balance now. And just, you know, that number is a big number and to see like what's the activity we're doing related to that might not be a bad idea.
Yeah.
You know, and because there's a lot of things, a lot of moving parts.
Yeah.
And I don't know if there's a way, you know, to summarize it or to group it in some of the projects that are related or something.
Yep.
Might not be a bad informational point for the board to kind of see once in a while.
That might be easier than showing the financials too, like here's this fund is pertaining to a specific project. Here's the money we've got for it. These are the things we've done thus far. We have so many contracts in place.
Yeah.
You know, it's a 3-year term, so
Right.
it'll be expended over that, you know, like that's way easier to explain to the board than than profit and loss and balance sheet stuff.
Well, especially on the profit and loss is zero every month. I've adjusted deferred revenue to zero out the fund.
Yeah.
So it doesn't give a lot of information.
Yeah, it's gonna zero out at the bottom,
Yeah.
but it's kind of like, okay, what are we
Because-
What are we
ultimately
spending? Yeah.
spending the money on?
Overall.
Might not be a bad thing to present.
Any questions?
No, I like that we don't have a finance here. That's-
Yeah.
Yeah,
Excellent job as
yeah,
always.
very nicely done.
Yeah. There. And it keeps getting better. Because you know what, we're doing a good job.
Yeah.
You know, we're doing a lot of different things and just keep expanding really our services.
Mhm.
So then will we be presenting this to the board this month?
Yep.
Yes.
Yeah, so Rich needs this by the end of the month for parish reporting. So.
Kayla and.
Kayla and Shelby, yeah, Rich has washed his hands of that. So,
I signed it, because it goes here, I don't know, pretty soon, so.
so yeah, we'll present it at the next meeting. Hopefully, we can get those tax exempt things cleared out by then, because that's really the last open item.
I was gonna call him today.
The meeting's the 25th, I think.
Correct.
Is it
In
in Dunkirk? Okay, that's typically where we've met.
Yes.
Now, does this group make a recommendation to the board or is it just goes to the board? I can't remember.
I think this.
I would think-
To vote.
Yeah.
Okay.
To
Accept it here.
Okay.
That's what I make a recommendation to the board, yep.
So do we have a motion to accept the preliminary audit of the 2024 financials?
So moved.
And I'll second it. All those in favor say aye.
Aye.
Aye. Opposed? Okay, we'll recommend it to the full board and we'll review the financials at the next meeting and those approved. Any other old business to come before the committee? Hearing none, we'll consider the meeting adjourned. Thank you.
Work.
Thank you.
Yeah, I had just a couple of things.
Yeah, great job.
Nicely
I
done.
mean, this is,
Yeah.